The asset market equilibrium or money market equilibrium will be determined by the interaction of demand for money and supply of money. So here we'll consider the demand and supply of money in real terms. We can do it in nominal terms also, but our objective of studying ISLM framework is to finally find out the demand curve of an economy. So that's why we will introduce price also. So supply of money is exogenously determined by the central bank. So it is given as M bar. So in other words, the real balance will be given as M bar by P. Now let us consider the demand side, which is the more important side of money market. So demand for money, we can write the real demand for money will be given as a function of two things. One is transaction demand, another is speculative demand for money. Transaction demand for money is basically the demand for money. Transaction demand for money is basically the demand for money as a medium of exchange. So, for purchasing or different types of transactions, we have to hold money in our hands. So, transaction demand for money, this is a function of aggregate demand or the level of output. So, this is the function of aggregate demand. So, what we see? We see that if aggregate demand rises, the demand for money to make the transactions will also increase. The second thing, this is the uniqueness of Keynesian theory. Speculative demand for money is a unique feature of Keynesian demand for money demand function. Speculative demand for money is the demand for idle cash in speculative purpose. In classical economics or in classical macroeconomic theory, there is no significance of holding idle cash. Instead of holding idle cash, you can convert your money into bonds, and from which you will earn rate of interest. So as per classical theory, rate of interest is known as the opportunity cost of holding idle money in the hand. But in Keynesian theory, idle cash plays a crucial role, specifically for the speculators. What is that? The concept is very simple. As per Keynes, you have two types of gain from the bonds. One gain is known as interest gain. The bond, if you hold money, hold bonds, the bond will yield some interest rate. So this is one gain, which classical economists also considered. But another gain which was introduced by Professor Keynes, that is the capital gain from bonds. If you purchase the bonds at low price and sell the same bonds at high price, you can make some gain. So, what the speculators will do? If bond price high, they will sell bonds. That means they will hold idle cash. To sell bonds, the idle cash in their hand will increase. Similarly, if bond price is low, what they will do? They will purchase bonds, and that means idle cash will decrease. Now, What is the indicator of bond price in the money market? Obviously the rate of interest. Because the face value of a bond is bond price multiplied by rate of interest. This is constant. So rate of interest equals to C by PB. So whenever we see PB falls, that means rate of interest will rise, and when PB will rise, rate of interest will fall. So PB high means low rate of interest. So whenever rate of interest is low, demand for idle cash will be high. If rate of interest falls, demand for idle cash will be high. And if rate of interest rises, demand for idle cash will be low. So we can see that demand for idle cash, LR, is the demand for idle cash, which is determined by the rate of interest. And if rate of interest rises, LR will fall, and if rate of interest falls, LR will rise. So, now by using the demand supply equilibrium, that means LR plus Q by demand for money equals to demand for money equals to supply of money. This gives us the money market equilibrium. And from here we get the famous LM curve. What is LM curve? LM curve is the locus. It is the locus. Locus of what? Locus of different combinations of Y and R, aggregate demand and rate of interest. What type of combinations? That maintain money market equilibrium. Now, so this equation gives us the money market equilibrium, and from there we will get the LM curve. So what is the relationship between R and Y? To find it, we have to differentiate it. So we can write that L dash dr plus K dash dy equals to 0, or L dash dr equals to minus K dash dy, or dr by dy equals to minus K dash by L dash. So K dash is greater than 0. Because we know that if demand rises, demand for money will rise, and L dash is less than 0, that implies dr by dy, that will be definitely positive. So LM curve will be upward sloping. Now, so we can draw here that if R is here, Y is here, this will be the LM curve. Now, what is the economic logic behind that? Let us consider, for any case, aggregate demand rises. So if aggregate demand rises, other things will constant. The transaction demand for money will increase. So just consider the money market equilibrium. Ky plus Lr equals to M bar by P. The money market was in equilibrium. Now what happens? This part increases. So we cannot say that money market is no longer, so money market is no longer in equilibrium. Demand for money is greater than supply of money. So we can consider there is an excess demand situation in the money market. So whenever there is excess demand situation in the money market, what the people will do? The people will start to get money by selling the bonds in their hand. So remember that the money market and bond markets are interrelated. So whenever there will be disequilibrium in the money market, automatically there will be disequilibrium in the bond market. Because here there is excess demand for money, so people will try to get money by selling the bonds. So consequently there is the excess supply situation in the bond market. So if there is excess supply situation in the bond market, the bond prices will start to fall. So as the bond prices starts to fall, the rate of interest will start to rise. And this rate of interest starts to rise, it has two impacts. First impact is that speculative demand for money will start to fall. And on the other hand, what will happen? We will find that if rate of interest starts to fall, then in the commodity market, what will happen? In the commodity market, the private investment will also start to fall. So that implies aggregate demand will again start to fall. So transaction demand for money will also, that will have negative impact on transaction demand for money. So this entire process will be continued unless we find that the money market equilibrium is restored. So first there was an increase in transaction demand for money due to increase in Y. After that, through the entire mechanism, rate of interest will rise, and for that speculative demand for money will fall, and also to some extent transaction demand for money will fall, and this process will be continued unless we find this. So that explains the direct relationship between rate of interest, Y and rate of interest, Y and aggregate demand and rate of interest that will maintain the money market equilibrium. Now, so any point on this curve will indicate money market equilibrium. But if any point is above LM curve, money market disequilibrium, below LM curve, money market disequilibrium. So what type of disequilibrium? Above LM curve we can say there is excess supply of money. So in the excess supply of money, what we will find? That rate of interest must fall to restore the equilibrium. Similarly, below LM curve, that means money market disequilibrium. What kind of disequilibrium? This is excess demand situation. So rate of interest has to rise to restore the equilibrium. Next, the shift of LM curve. So LM curve can shift in mainly due to two causes. Number one, if money supply rises, ember rises. So what you see, money market is initially was in equilibrium, ember by P equals to QY plus LR. Now if ember rises, what we will see? That real balance will be, real supply of money will be more than the demand for money. So we will find an excess supply in the money market. So what people will do to get rid of the extra money in their hand, they will try to start to purchase the bonds. So there will be excess demand situation in the bond market. So if there is excess demand situation in the bond market, bond price will start to rise and rate of interest will start to fall. So whenever rate of interest starts to fall, in one hand, what we will see? We will see that speculative demand for money will rise, and on the other hand, in the commodity market, private investment will rise. So aggregate demand will rise. That implies transaction demand for money will also rise. So what do we see? So at each level of y, so at each level of y, what we will see? There will be less rate of interest. So at each level of y, the corresponding rate of interest will fall. And by joining this point, we will get a new LM curve, L1, M1. So whenever money supply rises, nominal money supply rises, LM curve will shift rightward. So and vice versa, if there is any decrease in money supply in the economy, the LM curve will shift leftward. That means at each level of aggregate demand, there will be higher rate of interest. The same thing will happen if we consider there is a fall in price. If there is price level fall, so what we will see, real money balance will increase. And if real money balance increases, we have already got that LM curve will shift rightward. And similarly, if price level rises, real money balance will fall, and due to excess demand for money, the LM curve will shift leftward. So either there is an increase in nominal money supply or decrease in price level, LM curve will shift rightward, or if there is an decrease in money supply or increase in price level, LM curve will shift leftward.